Okay, so welcome back to the AI Hedge Fund Show. And as you know, I mentioned that going forward, I'll be sharing some of the AI picks with you, and I'll be sharing the due diligence process that I go through. So this is part of the due diligence process. Celsius Holdings is one of the stocks that the AI model is favors a lot. So it's been one of the high conviction picks for a number of weeks, going to months now. And there's a good reason why there's a good reason why one would believe it will continue being a high conviction stock. Unfortunately, it's currently not available on eToro, but I have suggested it to the guys and girls at eToro, and hopefully they'll be adding it as a tradable stock going forward. So, what is Celsius? So think of Celsius as an energy drink producer. So they basically develop, market, distribute, and sell calorie burning fitness beverages in the United States and around the world. So they are in business. Their competition would be Coca Cola, Pepsi Cola, Dr. Pepper. So you can think of also Monster Beverage, I think would be the most close competitor. And that's the space you're looking to really break through. And so far, they've been doing a good job. So if you look at their financial health, they have 6/6. If you look at future prospects, they're 5/6. So we'll later on go into detail as to why they might be messing up on some of these metrics. Why are we looking at this stock? Because it has had a massive run over the last year. So the stock is up around 800%, and this is where the 8x comes from. So we're basically asking, given that the stock has done 8x over the last year, do we think the stock is going to do 8x again going forward? There's room to believe the growth is going to continue because management has been executing pretty well. Over the last 3 months, the stock has been consolidating, so it's a good thing. It previously tested 40 and went up, and currently going back again. As long as this formation does not break down, I think the long-term move is upwards. So this is really a good time to get in if you've been on the bench. So you might want to dollar cost average in, so buy some shares around 50. It might come all the way to test around 42 again, so you might want to have some limit orders along this way so that you can dollar cost average your way into the stock. So, uh, in terms of valuation, the stock seems to be trading very close to fair value according to analysts. So basically, analysts put the stock around 48, and the current market price is around 49. So it doesn't get it better than this with respect to growth stocks. Why? Because analysts, one, want to hurt, so they usually hurt towards the low side, and two, they don't want to overestimate future growth, and so they always tend to underestimate future growth. So if you ask me what a fair value is, it's probably much larger than 48. So if you're getting to buy the stock around 48, you're getting a bargain. Okay. So I don't look at the price to earnings or price to earnings growth numbers because you're mostly backwards looking. For growth stocks, you really have to ask yourself, one, are they growing cash flows? Two, are they growing earnings without burning cash flow? That's usually what I ask myself. And we can get some information here from analysts. So in the past, they've been slowly growing earnings, and these positive earnings have slowly turned into positive cash flow. So as we can see from the recent earnings numbers, the free cash flow generation was around 2.8 million. So this is total free cash flow, and the free cash flow that came from the operations of the firm. So this is cash that is not necessarily coming from issuing new shares or issuing debt. So cash from what you do as a business. That was around 3 billion. So that's pretty good. And earnings still growing, revenue growing, and projections of revenue. So basically, analysts are projecting revenue to go through the sky. The problem is that at this point, management is still using a lot of cash and a lot of the earnings to drive these sales in the form of SG&E. So we don't expect the margins to suddenly become spectacular going forward. It's going to take a while, but the growth is there, and that's what we care about. If you compare them to the industry, they are growing at around 50%. They're forecasted to grow around 50% compared to the industry average of around 9%. So completely out of the league of their competitors. In terms of revenue, it's also forecasted to grow around 30% compared to the industry growth of around 5%. So if you're looking for the beverage exposure, and you don't mind growth stocks, Celsius is your stock. Okay, in terms of earnings per share, this doesn't look so good for the intermediate term, mainly because we expect earnings per share to over the next year more or less remain flat, and it's from 2022 onwards that we expect earnings per share to really increase, mainly because people are expecting management to dilute. They expect management to dilute us a bit, because to reconcile the flat earnings per share curve, forecasted share curve, with an increase in earnings, it has to be that management is expected to raise some extra money from issuing shares. But then, given that cash flow from operations is high and projected to be high, there shouldn't be too much of a problem. Okay, so in terms of forward-looking numbers, that's what it's looking like. Is there anything you should be worried about in terms of financial health? Not really, right? So in terms of financial health, they receive a 6/6. So Celsius has short-term assets that exceeds the short-term liabilities. So if all these short-term liability guys come asking for money, we have enough short-term assets to finance this. That never happens, but it's something you should think about. In terms of short-term assets are also large enough to cover long-term liabilities, which is really not something we would expect to happen. So Celsius is debt-free. So for people who don't want their companies to be holding debt, Celsius is a stock for you. Usually I like to see my stocks hold some amount of debt, right? I expect my stocks to hold, say, some fraction of sustainable debt that they can use to leverage up the returns that equity holders are going to get. But for a stock that is growing, you also don't want to take on too much debt, because if there's a negative shock in the industry, it means your revenue is going to suffer, and what might happen is that you do not have enough free cash flow to pay off the interest on the debt. So there's a positive and there's a negative side, and I would really love to see them slowly building some debt, not too much, but enough that they're able to cover it. I guess they might not have had debt, mainly because their cash flow was negative over the previous quarters, and it's just slowly turning positive. So I believe this might change in a year's time. So that is all about Celsius. I don't think there's anything else worth looking into. The average age of management is, we don't have that data here. We basically know people in management have been around close to 3 years. The CEO is called John Fendley. He's 40 years old. He's been in tenure for around 3 years, and his compensation is around $800,000, so pretty low compared to competitors who are taking home like 18, 20 million a year. And I expect this to grow, right? So we've been seeing that this number has been growing over time, and as Celsius continues to perform, we should expect this number to increase over time. Okay, yeah, so this is what I was looking for. So the board is made up of really old folks, right? The age is around 63 years old, and the average board member has been around for close to 5 years. So let's see if there's any issue with insider trading, and this is not good, right? So basically, over the last 1 year, insiders have sold approximately 1.1 million stocks. So from 9 to 12 months ago, 1.1 million was sold. From 6 to 9 months ago, approximately 17 million was sold. Again, which is not, so this is no, you don't want to see this, right? You don't want to see insiders selling so much. But then you also have to ask yourself, right? Would you have sold or not? You are part of the management of a stock which was trading around $4 US for a pretty long time, and then you see this explosive expansion in stock price during the Corona period. So this is the period during which management was selling so much. I don't blame them, and what I actually like is that since the stock price started consolidating, nobody has been selling, right? So since over the last 3 months where we've seen the stock price consolidate, there hasn't been a lot of insider selling, which is good news, right? So that is what you want to see. You don't want to see insider selling too much. Okay, so that's about it. The last insider selling was somewhere around 25th November, and since then it looks like they've stopped selling. So would I recommend Celsius? Yes, I will. I believe they're growing earnings. They will continue to grow earnings. And the earning growth is the kind that you want, the kind that brings in more cash and push the stock on a sustainable growth forward. Do I think it's gonna 8 times over the next year, 2, 3? No. Do I think it's gonna 8 times over, say, the next 10 years? Definitely. I think this is similar to the Monster Beverage story, and getting in at this consolidated price is getting in at the ground floor. We're here to take off, folks. And so let's look at these Simply Wall Street's quick checks. So basically what they're worried about. So what are the risks? It's been volatile over the last 3 months. Profit margins are low, just as I pointed out. So profit margins are around 6.5% and lower than last year. So last year profit margins were much higher. Again, shareholders have been diluted in the past, and as I said, I think over the next year shareholders will be diluted a bit. The positive stuff is that it's currently a profitable stock. Earnings are forecasted to grow by an average of 51% over the next 3 years. It is debt-free. It doesn't pay any dividend. We are growth stock pickers. The company's earnings are high-quality earnings. They have sufficient analyst coverage. There's no concerning events that have been detected. Their revenues are meaningful at 131 million, and they are continuing to grow this at 50%. So over time, it's going to explode. Their market cap is also not too out of there. So right, it's around 4 billion. And I expect as they continue to grow revenue and continue to grow earnings, this market cap should continue to increase, but not give it 10 years to go to like I'm calling for a 10 times increase, right? So where would I put it? You have to do the math. Okay, so that's about it for Celsius. If we want to look at the intermediate term, then we can look at the Wall Street Journal numbers, right? So in terms of how well have they done beating earnings, they've done a pretty good job. Over the last 4 quarters, they've almost always beaten earnings. It was only there was recent quarter where they slightly underperformed. So the consensus estimate was around 3 cents per share, and they came in at around 2 cents per share. So this is, I would say they've done a pretty good job. Beating 3 out of 4, it's good. And when they beat by a large margin. And it's been positive over the last 4 quarters, so that's also good. In terms of Q1 2021, so next quarter earnings are expected to be low, so close to 0, and I expect them to beat this number. So let's see how they do. In terms of analyst coverage, 3 months ago, 2 analysts were covering it, recommending a buy. 2 other analysts were recommending a hold. Currently, we still have 2 analysts recommending a buy, 2 recommending a hold. So the average is overweight. If you don't have Celsius in your portfolio, you got to put it in there. It's going to be a crazy ride upwards. And I don't think you'll be underpaying, right? So remember the guys at Simply Wall Street were saying the fair value is around 48 and the stock is trading very close to 48. So they're not really building in that growth. Whereas the analysts at Wall Street Journal are saying the average forecasted price for the end of the year is around 60, right? So there's at least a 20% buffer to the upside. So definitely you want to get into the stock now. That's about it. If you have access to Seeking Alpha, you might want to read up on what the ordinary investor has to say, right? I usually want to go into these comment sections and see what other stockholders have to say. And for Celsius, it's mostly positive news. There isn't really that many negative comments. So I'll just read one that says congratulations, yeah. Basically a lot of positive news because a lot of people got in low, right? So the reason why people are so positive was that last year when things stumbled, that was when people got in. So people were buying at around 4, around 5, and they've ridden the stock all the way up here. So basically they have seen the 10 times of their holdings. So the question is it going to 10 times again? And I think yes. I expect the stock to be trading at around 620 in 10 years time. In 1 year, I expect it to try and touch 100. It should consolidate for a couple of months and break out to the upside. Those are my expectations. So that does it for today. Thanks for tuning in. If this is the first time you're hearing about Celsius, do leave a like and a comment in the comment section so that we keep the stock picks coming. hopefully we will start getting in on some of these stocks at levels like this and on levels like this going forward. Okay, thanks for tuning in. Subscribe, hit the like button, leave a comment. See you guys next week.